All right, so let's get to it. So first off, we have our disclosures, and this presentation is about bulls and bears, lions and lambs, anxiety in the markets, Fed and inflation in September 2022. A little overview here. So without bulls and bears, there are no markets. In other words, if there's not differences of opinion and value, there is no trade, there is no market. So just a bit of a level setting there. We believe that opportunity can be in volatility. Second, recency bias and anchoring. These are two biases that can cause harm and cause poor long-term decisions. So think about recency bias being something where you have a recent event and you extrapolate that out into the future, or you overweight that outcome more than historical information. So something that happened recently, it's something you might place more weight on. And then anchoring. So this happens a lot within portfolios. If you have reached a certain watermark, a certain level of assets, and then you have a depressed market like 2022, there can be a tendency to anchor on what was once there and could cause poor decision making, such as changes in investment strategy, fear of losing more, or increasing risk. So very, very important to have the development of a comprehensive financial plan and ongoing review. We are going to dive into what's happening in markets, the Fed with interest rates, and why would anyone want to understand this? Well, we're going to make you a little more knowledgeable today, hopefully. And if you have any questions at the end, let us know. So what is the point of the Fed in a simply explained way that you could explain it to your great grandfather, great grandmother, or your 10-year-old? Okay. So best way to think about this is like a seesaw. If you think about the Fed regulating short-term interest rates, kind of like a seesaw, if they are going to be raising the short-term rate, that is typically to control economic activity or to decrease inflation. Well, what happens after a pandemic when you have a massive, quick, sudden recovery and pent-up demand? You're going to have inflation. So we have inflation, and the Fed has the difficult task of trying to simultaneously decrease inflation without completely destroying the economy. And so what you see when the Fed raises rates, when the market reacts to that, it is forward-looking and pricing in the risk of economic activity being lowered. And we're going to get more into this further in the presentation, why it is not a massive concern for the long-term investor. Let's reverse this. So let's talk about why the Fed would lower short-term rates. Well, when you go through the economic cycle and the economy is not doing well. So let's talk about the last time that was in the financial crisis or during the pandemic, and they effectively cut rates almost near zero. Now, what would that do? What's the purpose? The purpose is to increase economic activity, but also they could lower short-term rates to try to combat deflation. Usually we're talking about economic activity, and right now today we're talking about inflation, so they're raising rates. Very simple, easy way to understand. Think about a seesaw. All right, so let's zoom out here a little bit and let's talk about financial markets. And what we're looking at here in this graph, let's start with these shaded regions. These are US recessions. Here's the date at the bottom of my screen, 60s, 70s, 80s, 90s. So this encompasses most of people in, watching this video in their lifetime. Okay. This green line is the S&P price index, not total return. It's just the price index. So we don't make it parabolic. And then we have the US aggregate Bloomberg index here. Takes us back to a point in time in the 70s. And again, not total return. We don't want to create a parabolic graph either. So here you are with the US bond market. And then at the bottom, we have US effective federal funds rate. So what we just talked about, that was in blue. So that's the Fed raising or lowering that short-term rate. You can see they did that in the late 70s, early 80s to try to combat inflation. And here's inflation in green. Here it is going up. There's the Fed raising the rates. Here is CPI coming down. Okay. What you'll notice is you have recessions. That's a part of normal investment activity for a long-term investor. Very normal, but you have to zoom out because remember that anchoring and recency bias we talked about? Very, very easy to be focused on what is happening here and now, right up here. See my cursor up to the right? Doesn't feel good. Does not feel good to have assets lose value. However, you have to zoom out. You have to understand what the Fed is doing, why they're doing it, and have to understand that recessions are part of an investor's lifetime. Some timeless principles here. There will always be fear and greed. That's human nature. That creates markets. Time in the market, not timing the market. Back to that last graph we talked about. Trying to time, get in and out at certain times, try to avoid recessions. Remember, we're talking about a long horizon as an investor. Now, that does depend upon a properly constructed financial plan and investment plan for varying buckets of assets. Longer term investment should be longer term, medium term should be medium term, short term should be short term and have cash. Some musts, as I just mentioned, proper portfolio construction and financial plan, understanding income, expenses, assets, and debt, along with your goals. Without that, very, very difficult to construct much of an investment plan if you can't follow a financial plan. Education, that's why we do these videos. We want our clients to overcome the emotional decisions and biases that we all have. There's a whole book on them. And we want our clients to be armed and have great education to take a step back and understand what's happening so they can make the right decisions. Lastly, understanding myopic loss aversion. Right now, that's probably being tested. That's fight or flight. So when markets go down, stocks and bonds go down, that causes that fight or flight. And losing does feel worse than the euphoria of gains. So the point here is be educated, meet with your advisor, review your financial plan, and make sure that your investment portfolio is properly constructed to follow that plan. Thank you, and God bless.